Hello, welcome to Any Answers Answered for January 2017. Hopefully you'll find time to quickly watch over this video. I appreciate many of you doing tax returns this month galore. However, we have two questions which have been raised which we just want to have a look at. The first comes from GCG007. I don't know if he is a spy, but he has a question relating to a residential property which a client has owned for 15 years. The property was furnished holiday let for 3, then standard letting, if you like, for 2, didn't meet the requirements. And then after that, 10 years of him living it as his principal private residence. Now, the suggestion of how we're going to claim relief on this, I think is wrong, but we will just go through it. I assume, says the author, he can claim PPR for 10/15, seems reasonable so far, and letting relief for 2/15 of the gain, obviously the lower of 40,000 or the gain. I can also deduct the CGT allowance for the year, fine. As the client is a higher rate taxpayer, is the tax payable at 28% on the remaining balance, or is it 2/5 of the gain at 28% and the remainder at 20% because it's furnished holiday letting? Let's take this one step at a time. First of all, 28 versus 20 as far as residential property is concerned, all going to be 28, isn't it?
It is. It's the upper rate gain. And if you dispose of a residential property interest, RPI, then the upper rate of capital gains tax will apply. So either 28% if it's above your basic rate threshold or 18% within basic rate. And that is unequivocal. This is a disposal of a residential property interest and therefore disregarding any reliefs available, it will be 28% if he's a higher rate taxpayer.
The assumption he's obviously made is that furnished holiday letting sort of qualifies as a business, so does that turn it into a 20%? The answer is no, it doesn't. But actually, had it been furnished holiday letting throughout, it still wouldn't have been 20 actually, because it would have been 10%, I think, as a entrepreneur's relief.
Then the contribution made by Portionine 11, who does point out quite correctly that if the disposal qualifies for entrepreneur's relief, which a furnished holiday letting gain could qualify as, you'll benefit from that lower 10% rate.
Okay, and the letting relief isn't restricted to 3/15, is it? Because furnished holiday letting is still letting.
That's right.
And therefore potentially 5/15?
Correct. Just going back onto the entrepreneur's relief point, you need to meet the conditions for the 12 months up to and including disposal. And so if the property was available as a furnished or qualified as an FHL for that last 12 months, that would then give the gain the benefit of the 10% rate.
Okay, and obviously the PPR element, had that been at the beginning, would still be disregarded in looking at the overall 15-year period. So the answer is PPR, no problem at all, but actually there isn't a distinction in letting relief between the type of letting between FHL or non-FHL, and obviously these days we see a lot more of that because they made the test harder to pass. But then on top of that, no question that it would be 20% because it's residential property, full stop, therefore 28%.
I agree.
Excellent. Our second question, it comes from a taxi boy and has a question about gift with reservation of benefit. Very brief summary of the story. Mum's house has been gifted to the son. The son charges rent, full market rent, to the mum. He receives rent from that. He pays tax on that rent, but then he's paying the net amount that he has received back to the mum. An interesting gift. It's almost a gift with reservation with a gift with reservation. What do you think?
Well, it does very much depend on the circumstances, and if you break it down, then yes, the payment by the mother of the market rental will avoid the reservation of benefit rules. However, as the first respondent in the Any Answers section says, if the payment of rent is a sham, then there will still be the reservation of benefit. And the question really is, how much malice aforethought is there in all of this? Again, Portionine 11 makes the point that if they enter into a formal rental agreement, the mother is to pay so much a month, 500 a month, while living in the property. But separate from that, every so often the son makes payments to his mother. The fact that they might average out at £400 a month, just under 5,000 a year, might be coincidental. Would that cause an issue? The payments by him back to his mother could be identified as potentially exempt transfers, which one of the other contributors, Adam 12345, points out. However, it's not mentioned in the Any Answers comments, but if the son is paying his mother £400 a month, then that would be a gift out of income as long as the conditions for Section 21 are met, so wouldn't give rise to an IHT charge there. But the linkage between them could well make them associated operations, which would then, and nobody mentioned associated operations, but that would invalidate the idea that by having the mother pay the market rent, they avoid the reservation rules. So I think considerable caution needs to be advised here, and we would certainly not recommend that clients enter into arrangements like this with the intention from the outset that the payments made by the original owner of the property are then repaid to her by the person to whom the property has been given.
But with gift with reservation of property, there has always been not a very long list, but a fairly standard list of things we can do to try and ensure that the property has transferred and is accepted to have transferred. The person moving in, the restriction of which part of the house is now occupied by the mum, all that sort of thing. There are ways and means of trying to structure these deals. And one thing that isn't mentioned that I could see, there's no discussion of how much the son can deduct before he's paying the tax, in fact. And it could quite easily be the case that once he has perhaps a mortgage or he has other costs relating to the repair of the property, they can be deducted before he's paying this tax, and that could end up increasing the amount that goes back to the mum to such a point where, as you say, it really starts to look like a scheme, and then you're going to have some really big problems.
That's right. It's not suggested in the thread that the son might raise a loan on the property, but of course if he does have a mortgage on that property that his mother's living in, then that would be deductible from the rental income. The interest would be deductible from the rental income that he's getting from her.
But of course only for another 3 months, and then we'll start to have this calculation on residential.
Well, the implication in this case is that he's only a basic rate taxpayer, so he wouldn't be that much affected. There are, of course, issues with child benefit charges and so on by that change in the mortgage interest relief. But yeah, interesting case.
All sorts of fun for later in the year as far as mortgage interest is concerned, but as far as this particular question is concerned, a relatively straightforward consideration of gift with reservation, and a very common area that we still do come across an awful lot. Do continue to post on Any Answers, and we look forward to choosing a couple of questions next month, and we'll try and do our best to answer them then. But for this episode, bye-bye.